Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
It's hard to imagine that it's really been less than 24 hours, a little more actually, since President Biden's stunning exit from the presidential race. And with that, the rapid ascendancy of Vice President Harris. She has quickly consolidated, as Ed just pointed out, support from some powerful Democrats. She seems on track to win the nomination for sure. For a closer look, we are joined by John Lieber. He is head of research and managing director for the U.S. at Eurasia Group. John, thanks for taking time to chat with us. I think we can agree this race is certainly a lot more interesting now than it was a week ago. What's the most important thing for Kamala Harris to do between now and the Democratic convention?
I think that Kamala Harris starts the general election campaign as soon as she can. She's got to define herself to the American people. This offers, the fact she's swooping in mid-campaign offers a chance for a reset and a chance for her to define who she is in their eyes, as she's been relatively low profile. And then the big thing for her is going to keep the focus, keeping the focus on Donald Trump, because that is really what she wants this election to be about, reminding voters what they didn't like about him in 2020.
Will she be a candidate that speaks about uniting America, or will it be, as you just suggested, tear down House Trump?
I think it's going to be pretty aggressively anti-Trump, because that's the thing that unites Democrats, and that's what excites them. And she wins this race by getting 50% plus one of the Electoral College, and the way to do that is to get every Democrat out to vote, and then make the case for independent voters that there's a reason they kicked this guy out 4 years ago.
What about a vision for the future? How might she outline that?
That's a great question. And, I think that really hasn't been a focus of the Biden campaign so far. And this raises one of the interesting points about Harris, is that we really don't know what she stands for. She sketched out a pretty progressive campaign platform in 2020 when she lost the Democratic primary. And she really hasn't had much of a policy portfolio as vice president. So I think that's something that we'll probably hear in the coming weeks. But I don't think that's what this campaign is going to be about.
Can she let former President Trump hang himself? I mean, he's made some comments about women candidates in the past that were kind of in the sexist or racist territory. He called Senator Elizabeth Warren Pocahontas, and he called Nikki Haley bird brain.
Well, it's worse than that. He's been found civilly liable for sexual assault. So the guy's got a terrible history with women here. And, one of the growing divides in American politics is the gender gap, where Republicans are appealing more to men. You saw that on display at the convention last week with all the wrestling stuff and the MMA stuff. And the Democrats are becoming the party that speaks much more to the needs of women. So that's a growing divide. And these two candidates really typify that.
She's got a decision to make very soon, and that is going to reveal a lot in terms of her judgment and how she thinks when she selects a candidate for vice president. Do you have some advice? How should she approach this? And maybe there are a few names that you think would serve her well.
Vice presidents are typically chosen to complement or shore up kind of the weaknesses of each candidate. Biden was chosen as Obama's vice president because he had foreign policy experience. Pence brought the loyalty of evangelical Christians, and Harris brought, a younger female African-American, Asian-American person on the ticket for Biden. So I would suspect what she's going to do is try to diversify the ticket. That means finding a white male, younger than she, who speaks well and probably is from a swing state and has a future in the Democratic Party. And there just so happens to be quite a few of those available to her, the most prominent of which I think is probably Josh Shapiro, the governor of Pennsylvania, but also Mark Kelly, astronaut, senator from Arizona.
Let's flip it around and be fair. How should President Trump attack Kamala Harris?
The attack on Kamala Harris is that she's not qualified for the job, is that she's not smart enough to be president. That's what they're going to say. And that she's out of touch with the American people because she is a San Francisco progressive. And that could very well work. They're gonna paint her as somebody that benefited from favoritism over the course of her career, hasn't done much to distinguish herself, and doesn't deserve to be running for president. Is only there because she kind of failed upward under Biden.
So, as I mentioned at the top, it's been a little more than 24 hours. In that time, Kamala Harris has raised a little more than $80 million. We don't have any polling data yet. Would you care to hazard a guess as to what the polls may indicate as soon as they kind of are revealed later this week?
So it's interesting because all of this is happening in the context of Trump getting a little bit of a polling bounce after the assassination attempt. So this has actually been, any polling bounce he might get from the convention. So this has actually been probably his best moment of the campaign so far. But now suddenly what you see is typically after these campaign events is a lot of energy where Democrats are answering their phones and Republicans aren't. So I would expect to see Harris come out of the gates quite strongly in public opinion polls, and Trump start to fade a little bit, leading up to a debate between the two, which is going to be probably the most important event on the campaign trail.
Okay, quick one. You got 20 seconds. Who's going to win?
Right now, I'd bet on Trump. I mean, I think that he's got the advantage. He's leading on top issues, and Harris still has the baggage of inflation and the Biden administration, but she could turn that around. Like I said, this is an opportunity for a reset.
John, we appreciate your time. Thanks for joining us tonight in the U.S. John Lieber is head of research, and he's also managing director for the U.S. at Eurasia Group.
Margie Patel, Senior Portfolio Manager, Multi-Asset Solutions at Allspring Global Investments. Margie, always a pleasure to have you on this program. Let me get a little colorful with the first question. Can we sense, we had a big rally today, can we sense a little Buy America in this? In that it looks more like an interesting election now coming up in November. No longer two old white guys, now one old white guy, and a woman who is also a person of color. Is there any sense of that in the flows that we saw today?
I really couldn't discern that. I think it was more a bounce back from last week, which was extreme nervousness, anxiety over what will the second quarter earnings look like, especially for tech. So we had those big drops in a lot of the names that had done so well in the first half, and we had pretty much a bounce back today. And I think now we're really going to start to see those names roll out. Tomorrow we have Alphabet, for example. We have Tesla, and so that'll really be an indicator of what's going to happen. But I think once again it's going to be a good quarter.
So we have the PCE, obviously, at the end of the week, the Fed's preferred measure of inflation. The Bloomberg forecast is looking for something that's very, very small. And when you look at the core PCE, only 0.1% for the month of June. Are you confident that we're going to get at least 2 rate cuts from the Fed before the end of the year?
You know, I actually think it looks much more likely that we'll get at least 2 because inflation is going the way that they would like to see, number one. But also there are signs in the economy that the economy is slowing down. Unemployment may be going up a bit. Housing looks as if it's stalled out. So I think they may be just as concerned about the economic growth as they are about inflation. And I think Powell even referred to that. What keeps them up at night is what's happening to labor. So I would think that they'd be much more sensitive to these little glimmers here and there that say the economy is decelerating. And even if inflation isn't exactly what they like, I think that will encourage them, maybe even before September, to make a cut.
If you're a bull, today's action was pleasing because it was a little less about rotation and more about broadening, with a rising tide lifting all boats. You not only had the Russell 2000 up, but you also had the mega caps up. What was the sort of thinking behind that?
Well, I think you've had the small caps lag so badly. I think we had again, as part of this sort of nervousness about the trend of the market for the rest of the year, bounce up. But I think the fundamentals, frankly, are still with the large cap companies and large cap tech companies, communications companies. So I take the broadening out with small cap with a grain of salt. I think that the best return is still going to be those larger companies because they're going to have the fundamentals behind them and actually have growth that's better than any other sector.
So I'm curious, Margie, to get your take on the path of the dollar. We talked about your expectations for cuts in interest rates. The path of the dollar going forward, it would appear would be to the weak side. And then I'm also curious about how that may inform your thesis on investing strategies, and particularly in international companies that may benefit from a weaker dollar.
Well, I think that there's really a limit to any weakening of the dollar. I think that'll be very, very small because at the end of the day, it's still the safest place for investors to put their money. And so I think that particularly when you look around the world, and most countries are having very, very sluggish growth, maybe even recession, wrestling with very high budget deficits as we are. So I think that's going to keep a floor under how much of a weakening you could actually have in the dollar.
One of the other interesting things I noted today was Verizon, which is a company that a lot of people might have been buying because it offered a high dividend and it has a kind of subscription-like cash flows. Verizon missed revenue estimates today and sold down 6%. I mentioned this more on the dividend side than the company, so I'm not asking you to comment specifically about Verizon, but it does show kind of the dangers of buying stocks that you think are quality with a good, solid dividend when they can miss too, and then you can wipe out the dividend in one fell swoop.
Well, that's right. And in fact, that's really been the story ever since the Fed began raising rates in 22. Many investors look for defensive companies, low PE, high dividend yield, and really got left behind because those kinds of companies have had the poorest performers by a long shot compared to other sectors. So I think it's still not a strategy to make money. I think it's still been a money erosion strategy. It's better to look for growth, good fundamentals, and take a less dividend because you'll get much more in capital appreciation.
Margie, are you finding opportunities that are interesting in offshore markets these days?
Well, I think the U.S. is the best economy, and I think we're gaining relative strength, particularly with reshoring. You can see that China is on really a descent, lower and lower growth, lots of problems there, and that feeds out into a lot of the emerging markets, the weakness from China. So we still think U.S. is best, and that's where the best companies are and the best opportunities are.
But Margie, if you like mega cap, and it sounds like you do for all the reasons that you've already stated, how can you not like TSMC? How can you not like Samsung and some of these other type companies that just aren't based in the U.S., they're based in Asia? Well,
yes, I think those. I think that clearly those companies in Taiwan are very, very attractive, and they will continue to be, I think, good companies. But so many companies in the U.S. that do rely on Asian companies to supply them, I think will still be good investments because I think they still can have the growth and the demand. So we're not too worried about those.
We were talking a moment ago about the earnings that we'll get tomorrow from Alphabet and Tesla. How are you positioned these days, let's say in the mega cap tech space? Is this something that you still want to be exposed to in a major way, or are you reducing your exposure?
We had made a very, very small reduction in the mega cap names over the last month, feeling that they really had performed about as well as you could possibly expect and were due for a little correction. But, fundamentally, they still have the growth. They still have better growth than any other sector out there. So when you look about where you can get out of these mega tech names, high growth, high quality, what other sector can you go to? And really, they're, frankly, are far and few between, maybe a few industrial companies, a few things on the communication side, but basically we think that those companies are still going to be the leaders for the rest of the year.
So I note here that you like some of the independent power producers like Eaton. One of the things that's happened with them, though, is they seem to be kind of maxed out on valuations. So you're not worried about those high valuations? They've got forward PEs up there around 30-ish.
Well, it's interesting that some of the industrial companies like Eaton, like Parker Hannifin, have actually performance this year that's equivalent or even better than many of our tech names. And because they're in those sectors in the industrial markets that are going to have very high growth, they're tied into fortifying the electrical grid, expanding that, increasing that, more technology incorporated in products, aerospace. And so those actually are very, very attractive sectors. So we like those in the industrial space because they have the same growth characteristics that the tech space has.
Yes, and obviously tied a lot to powering data centers, so kind of tied into that AI trade. Margie, thank you. Margie Patel from Allspring Global Investments. Thomas J. Hayes, Chairman and Managing Member, Great Hill Capital. Thomas, Doug mentioned it, and Tom just reported on it. Earnings will be a major focus coming up. I heard this morning that if you strip out Tesla, the Magnificent Six is expecting earnings up 30% year on year. The other 494, about 5%. What do you choose from?
Well, this is the reason that we see a lot of skepticism around this violent rotation that started about a week and a half ago, Brian. A lot of people think this is going to be a fake out, but actually what you're seeing is a deceleration. So if you thought that difference was big for this quarter, back in Q1, it was 50% earnings growth for the Magnificent Seven and negative 1% for the unmagnificent 493. And by the end of the year, fourth quarter, it's going to completely flip on its head. You're going to see 17% earnings growth for the Magnificent Seven and 19% for the unmagnificent 493. And that's why we think this rotation is real and it is durable because it's underpinned by earnings and Fed cuts coming to a theater near you.
So will that be amplified when we get the guidance from these big tech companies?
I think so. Look, they've had a tremendous amount of CapEx. They're all racing to hoard the GPU chips. And, you saw the article, the $600 billion question, where are they going to get the revenues to support all the spend on GPUs that they've all been trying to hoard from NVIDIA and pull forward all of that demand? The revenues simply don't support it. So I think that's going to support the deceleration story, albeit there'll be great earnings and there'll be great earnings growth. It will just be at a lower pace while the rest of the market goes from negative earnings growth back into positive earnings growth. And so what we could see is the indices, market cap weighted like S&P 500, more subdued because the heaviest weights will be consolidating, while under the surface, there'll be tremendous opportunities to make money.
Yeah, so it'll look like an average day, but you actually made money. However, your thesis, while I love it, if it turns out to be true, it's quite dependent, don't you think, on growth holding up?
It is. There's no question about it. I mean, even if you look deeply under the surface at small cap earnings growth, which have had really not strong earnings growth, 4.1% expected for this year. That's going to accelerate up to 17.7% next year. So that is a sign of growth. And the underpinning of this that not a lot of people are talking about, Brian and Doug, is the destocking cycle is about over. For many companies, you've heard in the last 1, 2, 3 quarters, that's done. And the restocking cycle and the CapEx cycle is just picking up. And then you have all the reshoring to support it. And manufacturing, which has been in a clear recession for over 2 years, is now starting to show signs of buoyancy. So all of these things under the surface point to healthier markets, not just controlled by a handful of stocks like we saw in the first half. 5 stocks generated 60% of the S&P returns.
So when I hear that, then I'm wondering, why should the Fed be aggressive in cutting interest rates?
Well, you do have slowing in the labor force, which is problematic. The key here is if you let it go too long, it becomes too costly to fix. So we're of the view that if they move in September, as the market consensus is pointing to 98 or 100%, depending on the day you look at it, chance of a cut. It may be more of a mid-cycle soft landing where 1 or 2 cuts could be sufficient, maybe 3 cuts. If they let it go much past that, I think the acceleration in the softening in the labor market and the deceleration now that we're seeing some of the auto insurance come down, owner's equivalent rent start to catch up on a lag basis. Inflation is a much easier problem to solve than deflation. Deflation is costly, it's long lasting, it hurts a lot of people. Inflation, if they move too early, they could always hike again. I know they don't want to do that. And I think the probability of that is extremely low. Hike early, you won't have to hike as much, and let's keep things on steady footing.
Now, we know what happens when too many people load up on one side of the boat. At some point, they have to rush to the other side, and it really causes a lot of sloshing around. You say the four most crowded trades are long the Magnificent Seven, short yen, short China, and short small caps. So would you flip all of those on their head, and we'll see how bold you are if you're ready to short the Magnificent Seven?
Well, I wouldn't short the Magnificent Seven, but I do think what's going to happen is they're going to underperform relative to the unmagnificent 493 that are just catching a bid finally because their earnings growth is starting to support that bid. So I think you're going to see some underperformance in those crowded trades. Some of them will probably cool off, but on balance, maybe consolidate performance for 4 to 6 to 9 months.
Which of those four look best to attack? Would you say maybe it's shorting small caps, that's a good one to flip?
Oh, 100%. You want to be long small caps for the next 6 to 12 months. And history supports that out. After the first Fed cut over the next 12 months, small caps outperformed large caps since World War II by about 11%. So history is on your side with long small cap. I think China equities, we didn't get the boom we wanted out of the third plenum. However, we got the surprise cut this morning. I think more to come on the property front, and the valuations are simply too cheap. It's been a long wait for a year and a half, dead money. The market's been going sideways. You're seeing some smart money selectively start to filter into highest quality China equities. Mm-hmm. I think small caps is an easier trade. And then short yen, you're going to see potentially some intervention. And with the Feds starting to weaken on a relative basis, I wouldn't be short yen in the hole here either, to be honest with you.
So maybe I'm going to be short the dollar, particularly if the Fed is going to cut, in your view, maybe as many as 3 times. And if there's going to be a bit of short covering in yen because of it being a very crowded trade, and at some point the BOJ is going to move and tighten conditions in Japan. Is it wise to be short the dollar at this point?
Well, I think you're right, and I wouldn't play it explicitly through short dollar, but I would play it through what benefits from a weakening dollar. You're correct on direction, but what's the best way to express it? We like international stocks, which have underperformed relative to U.S. stocks. And then as it relates to rate cuts, we like small caps will benefit, cyclicals will benefit, and REITs will benefit, interest rate sensitive. So I think the biggest way to play the weakening dollar over time is going to be to have some international equity exposure, which really, if you're biased by recency bias, where international has just underperformed for so long, if you zoom out for the last 50 years, you've had some meaningful periods of outperformance, and I think we're right on the cusp of one right now. The band has been stretched to such an extreme level, it might be time to take action.
All right, I got $1 million to invest. Give me your number one unassailable back up the truck bet.
Oh my goodness, this is tough. We run a concentrated portfolio. I can't give you one, but I'll give you a couple of the names that I feel very confident about because we can't predict which ones are going to pop first, but we know if we use a reliable framework and buy quality when it's on sale over time, we're going to get full value.
Quickly, Thomas, quickly.
We like Disney. Okay, that's undervalued. You're basically paying for the parks and consumer products and getting the TV, the theatrical, and Disney Plus for free. We think that can go from 94 to 150 plus over the next few years. And GXO Logistics, there was a pull forward on products. Then to services, now it's becoming more balanced. Their business is going to come back full steam, and they're estimating nearly double EBITDA by 2027.
All right, Thomas. Well done. Well executed. Thanks very much for joining us here live on the program. Thomas J. Hayes, Chairman, Managing Member, Great Hill Capital. Sandi Bragar, Chief Client Officer at Aspiriant, with us live here on the program. So a pretty good bounce here in the market today. I'm curious what you see driving that. One thing I would mention is that we had some fears about a little bit slower growth, and then we got a pretty strong retail sales report. And it seems like now that people are feeling a little bit more wholesome about the backdrop. Do you agree?
We do agree, Brian, and it's great to be here with you. We do think the retail sales recovery last month is helping things along. It's nice to see consumers out there feeling stronger. There's a report within the Michigan Survey of Consumer Sentiment that there's a record high 30% of the U.S. population who have stocks more than 500,000 and 37% own homes worth more than $500,000. So we think that there's some pretty good wealth effect that's happening, along with some record cash flows from fixed income, which is helping create that tailwind to consumer spending, which should help the economy along, which we like to see. Makes us feel a lot stronger about seeing a soft landing that the Fed is trying to navigate into.
Sandi, before we get your take on a strategy that might be useful in employing if we're going to invest in markets, be it the bond market or the equity market, I'm curious, in your role as Chief Client Officer, do you have access to a lot of the feedback that customers are giving you right now? I'd like to hear you kind of summarize what your clients are saying right now, just about the current environment, be it economic or political, and how they're thinking about putting money to work.
Yeah. Well, Doug, our clients are corporate executives, family, business owners, entrepreneurs, people who are very busy in the economy. And we're hearing a wide range from them. On the political side, that's the most popular thing right now. Clients are asking if they should be repositioning their portfolio in response to the political news. Some clients are asking us about what life would be like if they moved out of the United States for the next few years. So there's a wide range of questions there. And then on the spending side, I think everyone's still feeling a lot of sticker shock on spending, but our clients have financial resources and they are not concerned about spending and investing at this point in time, for the most part.
Let me ask you a kind of a question that's a little silly, but just for fun. Would you advise a guy and his family who's lived in Asia for 40 years or so that this is a good time to come back to the United States, or would you wait 4 years?
Oh, Brian, is this a personal question maybe?
He's asking for a friend.
No, present company excluded. Yeah, asking for a friend.
Good friend, I see. There's so much that goes into that question of really understanding what's most important to the individual, to the family, what they're trying to achieve. But certainly, we think the United States has a lot of opportunity, and we are in a time of some political uncertainty for sure, but that's happening around the world. And really, it's based upon what's most important to the family, what their financial resources are, what their goals and objectives are. So we look at things very holistically.
Okay, so then the next question that I had, are you seeing more opportunity in the bond market or in the equity market? I guess the same rule of thumb would apply, right? It depends on the profile of the investor. But talk to me about the bond market. Is it too late to participate? I mean, if you can accept the notion that the Fed is going to be cutting interest rates, has that been fully discounted?
We don't think it's too late at all. We think, bonds have been, sort of boring and not very exciting and unpleasant if you go back a few years. So we think that they definitely should play a role in portfolios. The amount of bonds that we think clients should have is really based on those goals and expectations. But we don't think that the full entirety of the interest rate path forward is baked into the bond market at this time. And we think, in certain scenarios, there's still room for double-digit returns in bonds. So not that we're hanging our hats on that, but we are ready in our portfolios for a range of different outcomes, which we think is the most important thing for investors at this time, because depending upon the day, things look either great, good, or maybe like they need a little bit of help.
Yeah, one of the reasons I asked you that question about optimism in America was that we often hear about exceptionalism. And I know that, coming into this election, we saw an 81-year-old up against a 78-year-old for president, and some people may be losing a little bit of interest. So I asked a question to one of our guests earlier this morning, whether we could sense a little Buy America in this rally today. She scoffed at it, but that was sort of part of my thinking was it's looking like a more vibrant race now, isn't it?
I think there's more certainty. I think for the last couple of weeks, investors have been concerned about whether Joe Biden would continue to pursue the presidency or not. So it does feel like there is a little more certainty there that I think is providing a little bit of fresh air for some investors. But, there's a long time between now and the date we cast our votes here in the United States. And we are encouraging our clients not to get too caught up in political outcomes. It's very interesting as people living in this country. It's important for us to watch and pay attention and to understand how different political leaders could impact economies and markets. But really, it's the fundamentals of investing that's really important. And we've been telling our clients to keep their eyes focused on the long term, because in the long term, whoever wins the presidency doesn't have, a large impact on the returns.
Yeah, absolutely. And, we talk sometimes about how you'd have thought that oil would have done better under Trump than Biden, but just the reverse was true. There's so many other factors that go into it. Your answer was perfect. Sandi, thank you. Sandi Bragar, Chief Client Officer at Aspiriant.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.